All right, well, the week finished off on a little bit of a downer. We had a great reverse and bullish engulfing yesterday. It was a great reversal. I mean, the world was great. A few people are feeling good about themselves again for a full day, even into the open this morning. And then we got kind of the anti-reversal of that today. Now, I'm going to break down what I expect. I don't think we're going to be like tanking here. While I do think we'll ultimately go a little bit lower on this current run, I do think in the very short term next week will probably be more bullish than bearish. I'm going to break down why. I'm going to show you what charts and indicators are kind of leaning that direction, and then ultimately where we'll go after that. Where some important resistance levels are in case we do change the trend. Unlikely, but obviously there's always a chance. There's never 100% or 0% technical analysis. So I'm going to show you where those resistance levels are that we need to watch for in the next week upcoming, if in case things do turn around. And then I'll talk about what's kind of driving the markets here as usual. Some interesting patterns showing up there this week, especially in the sector rotations. And then we'll talk about our trade idea in a sector that's really been beaten up and more than likely will continue to be beaten up as a leading sector in the economy. So let's go ahead and get started. Today is Friday, October the 14th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started here, I invite you to subscribe to our YouTube channel with this icon here in the bottom right corner of your screen, or hit the red subscribe button down there. Hit the thumbs up icon to like our video, comment on anything that stood out to you today. Join our website at MarketScholars.com with that link right there in the top right corner of your screen. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching on our blog, check out some of these classes over here on the right. Come down to the bottom, click this heart. Again, second time after a 3-day streak of above 100, we had 2 days now, we're back below 100. So I appreciate those that are liking the video. Again, if you can just do that right now while you're watching, that really goes a long way to helping us out. As well as click that thumbs up icon there on this tab. Again, when you click on those, it opens up a tab for each. You can like that. That gets our content out to more of our followers there. All right, I also want to give a quick shout out here to Chuck for the super thanks that they give us here on YouTube. Again, you can get to that by clicking that, and then just click whichever one you want to put in there and hit buy us in. Again, that's another way to kind of help us out for doing these videos day after day. And then some great comments that we have here. I think we all are praying for the Fed not to crash the stock market and blow up the bond markets. But again, very similar to 07, 08. If the big Jim Cramer rant, that the Fed knows nothing, right? That these banks are failing. And it's like, well, the banks shouldn't have taken that as much risk as they did to go for as big of a returns as they were. This is what happens when you take big risks, going for big returns, and it blows up on you. So, if that's the Fed's fault, you do kind of have to, take a little bit of responsibility too for taking risk by being over leveraged and overexposed. And if that's the way we are right now, then we were in a situation we probably never should have been in if we're at the point of potentially blowing up because the Fed is bringing interest rates back up to kind of normal levels. All right, let's start off taking a look at the S&P 500 with the market forecast indicator like we always do. The S&P finished the week down. The S&P was actually a little bit higher than it was on Wednesday. The NASDAQ and the Russell were actually lower than they were on Wednesday. But regardless, the S&P hit that 23% retracement level and so far has used it for resistance. Remember this, we set the new low point here yesterday. So that actually moved the 23% level down. And then again, that's where we opened today and then fell. A little bit of a rally early, but then fell. Closing at the lows of the day, not the lows of the week. Holding there, the near-term line did rally into the reversal zone. Of course, it's not extreme. Like the momentum line did get to an extreme high point about the 90th percentile, but the near term line hasn't gotten there yet. Usually, this kind of move brings this kind of spark on the intermediate line can bring the markets on the momentum line, can bring the intermediate line out of the reverse, especially if the near term line gets above 90. So we'll see if this one did. You can see the intermediate line got above 20. This one did. It got the intermediate line got above 20. Didn't quite get above bearish territory, but at least it got above 20. This one did here. You can see it brought it out from above 20. So we'll see if this near-term line ends up getting above 90 and if it's able to get the intermediate line up above 20. I don't believe today was any kind of big reversal. Obviously, we did reverse some of what we lost, some of that move from, about half of it looks like, roughly, from yesterday. But, I mean, we're not going down to new lows. We didn't get another cluster. So we're hardly, I don't think, that was a one-day rally. I think we're still going to move higher. It'll just, again, it won't be straight up every single day like we've seen other rallies. It'll more than likely kind of gradually move our way up towards 3,800, which you can see now, again, is just a really strong resistance. So yesterday's low point set a really strong resistance level here at 3,800. Your 38% retracement level of this current decline is there. That's a pretty decent resistance in and of itself, but it's sitting right on top of the 23% retracement line of the long-term decline, year-to-date decline. That's a resistance level because you get above that, you're retracing the long-term move. Of course, you would also be breaking resistance on this current intermediate move. On top of that, you have this 38% level from the post-2009 low point, from the post-COVID rally. So this 38% level is based off of the low from the COVID low up to this current high. So that's acting as a support when you're above it, and we have broken it. So obviously, when you break support, it acts as resistance. So that's all three of those lines are sitting right smack dab, right on top of each other. It's amazing how Fibonacci, the magic, works. And on top of that, just a little bit higher is the 23% retracement level of the big long-term 2009 low point rally. So you have four Fibonacci lines off of multiple time frames, two to the upside, two long-term moves to the upside, and then this year's two moves to the downside. The year-to-date downside long-term move, which consists of three intermediate declines, and then the current one, the third one, the green would be on the current intermediate decline that we're on right now. So, and then now you also have the 30-day moving average below that. So you've got a lot of resistance to the upside. Doesn't mean we can't break it. It'll just take a significant move and a significant catalyst in order to break it and break to the upside. So, obviously right now we don't have that. Right, that's why we're not able to get going. I don't think we will. I think the near-term line will stay in bullish territory for a while. I think we'll get a good, next week I think will be a kind of a bullish week without very much of a move to the upside, but at least it won't be a bearish week. You can see that, when you look at the Hakinyashi candle here, we did reverse. We did get a higher close last week with the cluster. And then we reversed that. Instead of closing above that body, we actually closed below the prior day's body, the low point, which means that we have reversed this is kind of the anti-reversal. This set us up for a reversal trade, this kind of transition candle that we never did get. So, but I would not be surprised next week if we got a higher close, higher Hakinyashi close next week. With a relatively bullish week here that we trade in this area by the end of the week. The question will be, by the end of the week, are we closer to 380? Are we above 380? Or are we closer to, down to the low? Do we hit 380 really quickly early in the week and then drop like we've seen before? Or, so again right here, go back to a regular candle. I mean, we hit 380 already. We hit 3806 there on the 5th. So last week, we already hit 380. So are we going to hit it again just like that, which I expect that we will, very similar. I've told you before that, I expect going into October expiration, it will be very similar to going into this July expiration move. So can we hit 380 again? Sure. Will it be enough to change the trend? No, because you would still have that major resistance above us, and you had to be more than 2.5% above the moving average, and I don't think that we will. We didn't even get to the moving average last time at 380. Obviously, this time you would be, but I don't think you'd be more than 2.5%, which is what you need to change the trend for the S&P 500 at least. So that's kind of how I'm viewing that. Again, looking at the weekly market forecast, which gave us the cluster last week and a long lower shadow. At one point in time, we had a pretty decent lower shadow here this week, because with the close and near the high, we had that long lower shadow, but we ended up closing down, so we ended up with another kind of doji pattern right in between the 0 and 23% lines of this current intermediate rally and between the 0 and 23% lines of the current long-term rally that we're on right now. So very noisy move. When you're between 0 and 23, you're not retracing, you're just noise, right? You break 0 and you're continuing lower, you break 23 and you're retracing. Anything between 0 and 23 is just noise. And that's pretty much what we got all week this week, as noisy as it was. You take a look at some of these other charts here. So let's take a look at the Hakinyashi chart. I told you we got the lower close. Obviously, the PPO is falling. The PPO is the lowest it's been in 3 years. It's probably the lowest we've been in 5 years too. Yeah, so lowest we've been in 5 years here. So, which means the gap between the 10 and the 40 is the biggest it's been. In fact, that 6.29% is bigger than it was way over there. And you'd have to go back to, you have to go back past COVID. You have to go all the way back to 2009. Over here, we got 5%, and we were 4.5%. The last time that we exceeded this 6% below was there in September of 08, when we were just kind of, kicking that bear market into gear. We had the failed correction bounce, we had the return move, which we still haven't had yet for this bear market, and then we started to kick into gear. So that was the last time we've been this far below the 40-week exponential moving average. Again, going out even further here. Going out even further again, you can see by the time we got to 6% below over here in 2001, it was in March of 01. So when we had our correction and then our failed correction bounce there. But bear market, right? 1998, we did get 1% below, but not 6, which is where we're at right now. 1994, we got about 1% below, but not anything significant. 1990, we didn't get this far below. In 1987, we did. Obviously, it was one big move to the downside. You can see the candle there. It was one big move to the downside to ultimately hit the lowest point at 8.5% below. Obviously, that's not bear market mode. Bear market mode, you're around 10% or more below. So you came close to 10%, but at least you're further than 6. 1981, 82, a bear market, we never did get 6% below. You can see 73, 74 over here, we never did get 6% below. Again, I'll put this line on so you can see just how bearish we are right now, minus 6.29. So that's where we're at right now. You can see 1987, kind of a little bit of an anomaly there. A bear market there and a bear market there, and a little bit below in 66, kind of quasi bear market, and then again in 62. So you can see outside of those instances, outside of the really 1987, every other instance we've been this far below the 30-week moving average has been during bear markets. So again, another reason why I think that ultimately we will actually get this bear market started and get moving to the downside. Again, we're sitting pretty much right at we're sitting right at the 200-week moving average. So this is the 4-year average price. So that's why, if you just say that out loud, the market is sitting at the average price of its last 4 years. It's kind of hard to really say that we're in a bear market when you consider that. How can you be in a bear market when you're sitting at the average price for the S&P over the last 4 years? The only reason, again, why we think we are is because we were 45% above the average price of the last 4 years. That's insane, right? That's not just bullish. That's insane. That's ludicrous speed. And so the market has just corrected what was abnormal. I mean, when you're bullish, it's okay to be a little bit above the 200, the 4-week average. But to get 45% above, that's insane. As you can see here, when you look at the chart on this chart, that's essentially what we're seeing here on this chart. It's okay to be, a certain percentage above here. Let me go out. We'll do custom out to 1958. You can see here, right around is probably the median price is probably right around 15% is kind of what I was, right around this area here, 15-ish%. Seems to be kind of like the best fit trend line going all the way back, right? And so you can see even before in the 60s and the 70s, we spent more time below 15%, but still above zero, except for the bear markets. Really it was the 80s we started to spend more time above 15%. The late 80s we pretty much stayed right around 15 the whole time. And of course the late 90s we were pretty nuts. But then 04, 05 was pretty normal. Then again QE brought us up above it. But outside of QE we're pretty much always around 15%. So it's okay in a bull market to be 15, 20 maybe percent above. But we were more than double that at 45%. That's extreme. That's too much. And so it makes a correction feel like a bear market when you're that far above the average price for the last 4 years. And so again, when you say, oh, we're at the average price right now for the last 4 years, how can you be bear market when you're average? We're just average, right? That's the idea there. As you can see in a lot of these other instances, we get way below that line once we actually do get to bear markets. And of course you can see the 70 really is only the 81, 82, this one here, that wasn't so bad because again, while we did start, we did peak at one point in time 35% above the 200-week moving average. The CAPE ratio was in the single digits at the time. So that's why we didn't quite get the same downside that we've seen in other instances. Obviously, we still have 3 red arrows right now, or excuse me, we actually have 2 red arrows because the MACD is turned positive there. Everything, we do have 3 red arrows in the Qs, and we still have, we don't have 3 green arrows anywhere. So we don't have the green shading anywhere, which is what you need to start a bullish intermediate run. The DMI is still above 25 for the negative indicator, even if we're coming off of a lower high. We're still well below 20 on the positive. The RSI and the CCI are also still in bearish levels, at least in the bearish half of normal for the CCI. When you look at the Ichimoku cloud, we're well below the cloud. We're still well below the price. I do think, though, that over this next week, we're not going to get a new lower low. I do believe that we'll kind of trade up to 375, 380 by next week. So by the end of next week, this high tag is going to be way over here, which means on the Arun indicator, you're going to get a jump in the green line, but not all the way to 100. So if by the end of next week, we can't be above 380, which is where that highest point is going to switch to. If we can't get above 380, then it's going to have a hard time getting the green line to spike. If we're close, then there's still a good chance the week after that we can hit that, because by the time we get to the week after, the red line will be below 70, the green line will have hit 0, and we can make our run, right? We can make our spike up to the upside. But if we don't, if we finish. We start next week closer to these lows, closer to 350 or 360 than we are 380. Then we know we're on our new leg lower to the downside. I think we still have one more leg. So you've had multiple legs here. I think we'll have one more leg before the intermediate line then works its way back up above 60. It will get above 60 again. I don't think it will. It will get above 80 too far at least, and I don't think it will start a new. I don't think we'll get up to a higher high. Obviously, we have a lower low now on the intermediate line. So again, it's not impossible to get higher highs on the intermediate highs coming off of a lower low, but it's much easier to get a higher high when you're coming off of a higher low. So I wouldn't bank on us starting a new bullish run again. I wouldn't bank on even getting above 3,800 because I still think we're going to make a leg lower. Then I think your intermediate line is going to run back up towards 60 without getting it above it, which means that the price will probably work its way towards 3,500, 3,600. Best case scenario 3,800 again before we turn back over and roll over. You can see where we are relative to the moving averages. The MACD is still above its moving average. So until we get, I don't think that new leg lower starts until we get both these blue and orange lines closer to zero. Again, I think that will be by the end of the week. They'll be closer to zero. Then I think you'll be able to get your breakdown to the downside for that last leg lower. You can see the Bollinger Bandwidth is still falling. So I think it's still got to fall some more over this next week. That will get the bands have now come inside the Keltner channels just barely. I think they'll be well established inside by the time we're done with this consolidation. Then you'll break back down out of it for that, again, like I said, that last leg lower. So we've been green actually during the bullish move, and we stayed green, which means the bands have been outside the Keltner channels for the whole bearish move. You can kind of see when you get this like legs lower, you have that move up. I think we got this kind of move coming, and I think you have one last leg lower before we consolidate and start our return move. That third bullish move that starts bear markets to the downside. One last thing, let's take a look at the VIX. You can see the VIX has dropped back below 100%. So again, we haven't closed either one of these 3 weeks above 100%. As bearish as we've been, and we're being above 30, we still have not closed either one of these threes above 100% compared to VXV. In fact, we've only closed 1 week all year long above, and that was in April. Not even mid-June, not now. It was only 1 week that we actually closed the week above 100% on the VIX to VIX3M ratio. When you look at the VVIX, and you can see, it's actually working its way back down towards 100. I think we're actually going to get back below 100 on the VVIX. But I don't think we'll get a lower low. I think we'll come down to a higher low point by the time we get to the end of the week next week. And then I think we'll get that last leg lower starting soon after that. So probably a nothing week coming up. I don't think we'll really go up very much. I don't think we'll go down very much. I think we'll kind of go up and then down, retest 380 or get close to it, get to that moving average, not have enough juice to get through it, and then make it. Again, get through it though, things change. My expectations would change. Things would change if we get through above 380. But until that happens, you would expect resistance to hold until it doesn't. That's kind of how I'm expecting this near-term rally to go. All right, now let's take a look at how the week performed here. Again, remember we were, had the one real significant down day here on this week, but then reversed it. Let's go all the way to the 10th. You can see the stocks ended up, after being positive for the week at the end of the day, or early this morning at the very beginning of the day, the S&P ended up down 1.5% for the week. Emerging markets are down 4% for the week. The Qs ended up being down more than 3% for the week. You can see commodities and gold ended up down more than 3% for the week. Yields were higher, so it really, the only thing, these small cap stocks really outperformed. They were still down, but they really outperformed large cap stocks, which again is another sign that it's not bullish for IWM to be outpacing the Qs. So the more the Qs continues to underperform the small cap index, the more likely we are that we are in bearish mode, right? Especially kind of a long-term bear market type mode. If I switch it to a weekly candle here, you can see this is the closest And I guess we were a little bit closer in early March when the Russell went parabolic and the Qs was just trying to keep up. Qs had its run earlier, right? So this was kind of the Russells, the reopening trade, right? A very rare time where the Russell outperforms because of the reopening trade took off with the vaccine being issued. And so otherwise, normally when the Russell's outperforming and the Qs are underperforming, it's actually pretty bearish for stocks. And you can see, again, outside of that week, when the Russell went parabolic, which it's not doing now, this is the closest to the 200-week moving average that we've been. And at one point in time this week, we were below it. We're really moving down. PPO is moving, long-term PPO is moving down. The MACD is moving down. The CCI is hitting at minus 300. You're getting a bearish crossover there on the DMI. The RSI is down below at bearish levels, below 40. So everything's pointing to the Qs underperforming. And again, that's not bullish. That's bearish. And big driver continues to be yields in the dollar, right? So, even though there's a lot of chatter about the dollar move being over with, until it is over with, you ride the trend. It's still trading above its 8-day moving average very easily. Even though the MACD is below its moving average, we're kind of up and down, but pretty much below it. You're still that bullish. You can see even the weekly chart doesn't have the MACD below its moving average yet, even if the histogram's starting to slow down. So you're still getting a strong dollar. You're still getting a rise in yields now over 4% on the 10-year. That's still putting a lot of pressure on equities, even if commodities are kind of slowing just a little bit. We had gotten above the 17-week exponential moving average last week, and then ended up dropping back down below it and below the 23% line, and testing that eight days. So we'll see if we ultimately end up getting that bullish crossover where we get above the 23% line, get above the 17-day exponential moving average, and get the MACD above its moving average, and get a bullish run going again the commodities, which is, we're kind of stuck between two bad scenarios. You get back above this and you start trending higher again in commodities, and that blows up the inflation thesis, right? The bullish scenario where inflation drops and we go higher. But if we start dropping and start to fill in the gap between the 50 and 200, commodities don't do that unless you're in a recession, right? To make that big of a drop, to fill in that big of a gap, you don't do that unless you're in a recession, unless there's a severe demand destruction for the use of commodity prices that would cause that. So, you kind of got a catch-22 there. Either scenario right now is not looking too bullish. Typically, rising commodities is bullish, but again, the bullish narrative is that commodities are softening, and that will stop the rate hikes and get the Fed pivot that will push stocks higher. And that narrative doesn't seem to be playing out at all. Let's take a look at the sector moves here this week. Let's go to this week. So remember, it was strong dollar and strong yields was your bigger moves here this week. You can see technology and discretionary were your biggest losers, along with real estate sensitive areas and utilities and real estate. Communication services were down, kind of matching the market. You had a little bit of a reopening trade going on here in terms of outperformance. Of course, staples and healthcare are safe haven areas. They're going to do well when the markets are bearish. Usually utilities and real estate do too, though they're getting caught up in this interest rate wave, right? They're very interest rate sensitive, whereas staples and healthcare are not. So those are kind of acting as safe havens. Financials, again, kind of acting, considering how oversold they are, kind of acting as safe havens themselves. When you look at the long-term view here, go back, and let's go back to a long-term. And you look at XLF. XLF is did get last week below its 200-week moving average, and is trying to figure out what it wants to do here with a little bit of a doji pattern. So you can see it's been a little bit more bearish. It's had a correction, got a lot closer in June to its 200-week moving average than the S&P did. You've been a lot more bearish on the MACD. So the fact that it rallied, I think, is a little bit more of kind of an oversold technical rally. Of course, the other side of that reopening trade, so to speak, is industrials. And like I said, it's also below its 200-week moving average. So those aren't necessarily, they're those sectors, considering they're cyclical and they're kind of early. They're kind of telling you what to expect. They're already below the 200-week moving averages, where again we eventually expect the S&P 500 to get to as well. All right, one area in the market that's really struggling, of course, is the home building sector, and you can see Toll Brothers, kind of one of the bellwethers in the area, has been pretty sideways. Has been tried to get a good bullish run going here, but that's failed, and we've reversed back down. The intermediate line's almost back below market sentiment, and we're 5% below the moving average. Dark pink shading and a red line again for the first day. If you take a look at like its weekly chart, we just got a bear tag on this a few weeks ago. So again, that's if you don't rally from there, that typically means we're starting a bear market. In this case, for Toll Brothers, you can see that it is. Pull up the chart here. You can see it's well below its 200-week moving average, or 200 days, excuse me. But you can see it's also gotten below 200-week and now staying there, and pretty much solidifying that breakdown down towards the 62% retracement of the point of control, which is right around, $36 there. When you take a look at, again, some of the other oscillators, especially like the Ichimoku cloud here, easily below the cloud, have been for a while. A couple of tests of it, but came right back down. We were above the blue line, we came right back down below it. There's no trend yet, so there's still a trend to develop here. There's no trend yet really on the DMI. The ADX is below 20, but we did break above 30 and we broke down below 10. So that's what you need to get a trend going, is that combination that you have. If you take a look at the RSI and the CCI, you can see that we are heading towards bearish levels again, coming down from a bearish peak on both of these. And then you look at the Bollinger Bands, and with the bands really tight, the bandwidth is starting to rise. So again, when you look at the TTM squeeze here, we got red dots, so the bands are inside their Keltner channels. So when you have that, then that's setting you up for a new leg lower to the downside. And considering we're at the bottom of the value area for the year, we're at 52-week lows. It's a very bad sector and a leading indicator for the markets. I think it's going to lead us down the next couple of weeks. I think that gives us an opportunity to make a bearish trade on it. When you look at the chart here, or the chain, we bought the at the money put and sold one strike away for a $5 spread. So bought the 40 put, sold for, this is for November expiration. You can see the maximum gain is, it's a relatively speculative trade. Maximum gain is in the 1 standard deviation window. And I put a small risk on about half what we do normally, and getting it close to a 3-to-1 reward to risk ratio if it indeed works out. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, like us on Facebook and Twitter as well. Join our website at marketscholars.com. Have a great rest of your weekend, everybody, and we'll see you all next time.